Hi there. My name is Anil Jagmohan, Senior Investment Analyst at Net Group Investments. Joining me today is Mike Townsend from Ford Asset Management. As many of you will already know, Ford Asset Management and the team manage the Net Group Investment Stable Fund. Mike is a portfolio manager and he also analyzes global commodities for the team. Mike, how are you?
Yeah, very well. Thank you, Anil. Nice to be with you.
Excellent, man. Welcome, and thanks so much for joining us today. So, Mike, I've got two pretty probing questions for you. So, the first one is just about the new changes to Regulation 28 and specifically the offshore allocation and how that impacts the stable fund, please. So how are you guys dealing with it? Just a bit of an update, please.
Okay. Well, firstly, I think we must just say up front that we welcome the changes, as it provides greater degrees of freedom for asset allocation, and then also more confidence in moving funds back and forth between offshore and onshore again. We haven't had any knee-jerk reaction as a result of this changed legislation. The stable fund already has a meaningful weight in non-South African assets, whether it's directly offshore in Ford's global funds or via JSE-listed global companies. Now, instead of simply allocating more to the global funds, we are likely to change some of the JSE-listed global companies in the domestic component of the fund with higher conviction ideas directly offshore. We also are probably not going to alter the overall equity allocation or the underlying local global split, but we can simply replace some of the current domestically held global proxies such as Richemont or Bidcorp with better investment ideas directly offshore, which we feel will improve the overall risk profile of the fund. An example of this is the recent switching of some of the fund's Capital & Counties holding into the Hong Kong listed Wharf Real Estate Company. And at Ford, we believe that our global investment capability, where pooled funds are not customized for South African investors, whereas we have the potential to choose the best of both our local and global investment teams' ideas and cherry pick for the best optimal risk-weighted outcome for Net Group's stable fund.
That's excellent. Thanks, Mike. And just sticking with the offshore theme again, given your tons of commodities experience, I have to ask you specifically on the impact of the Russia-Ukraine conflict on commodity markets and the consequences for the stable fund in particular, please.
Okay, sure. Well, I mean, both Russia and Ukraine are significantly commodity exporter nations, as most investors will know. And the conflict has had a dramatic impact on numerous commodities. Just a couple of examples. They supply more than 10% of the world's coal, aluminium, nickel, and they're a big producer of palladium. They supply more than 10% of the world's requirements for crucial fertilizers, such as potash and ammonia, and then are obviously big exporters of wheat, barley, and even corn, or mealies, as we call it here in South Africa. So Europe is critically dependent on Russian gas, and the country also supplies close to 12% of the world's oil. So there is no ready substitute for these commodities. So the impact on prices has been dramatic. And we've seen the nickel and potash prices in particular that are up by more than 50%. Local investors would have noticed the surge in domestic petrol prices. And then gas prices in Europe have absolutely rocketed. So the difficulty is knowing how long the conflict will continue, and then how quickly supply lines will be resumed thereafter. And how will Russian sanctions affect this? How quickly can the Ukrainian infrastructure be rebuilt? It just feels as though there are lots of unknowns. And then these sudden price rises have a big impact on inflation. I mentioned the petrol price. Logistics costs will rise. Gas is used to heat greenhouses in the UK, for example. So there was a FT article recently saying that the prices of cucumbers and tomatoes will rocket as farmers cut back production or pass on these costs to consumers. But I think just when an international incident such as this conflict arises, it's almost too late to invest. One needs to be positioned beforehand, and all of our holdings have been in place for a while now. But perhaps to answer your question more directly as to how this has affected the Net Group Investment Stable Fund, in the domestic equity component of the fund, we do hold BHP and Anglos that are benefiting from the higher commodity prices, but we don't hold any platinum shares. We feel there's a bit more risk involved there, but we do have a significant holding in a gold ETF. But it's in our global funds where we are going to be direct beneficiaries. And these are important building blocks for the portfolio. Here we have access to pure play copper, where Freeport is one of our biggest holdings, and companies linked to the resource prices, but with less risk, because what inevitably happens is mining companies spend more and their costs go up. So we've got two streaming companies that benefit directly from commodity prices. And then we also have a significant exposure to a variety of companies that will be major beneficiaries of higher grain prices. Two of these are FMC and Nutrien, or, for example, are two of the fund's largest international holdings. And these are up 20 and 30% respectively year to date. So we feel we are well positioned to benefit from what has happened as a result of this conflict.
Thanks, Mike. That was very insightful. We certainly appreciate your thoughts and insights, and we look forward to chatting with you again soon.
No, it's a pleasure. Nice to be with you.
Great. Thanks, Mike. And thanks to everyone for watching. Have a good day.